Hello everyone, I hope you guys are doing well and studies going in full swing. Now in today's video we would be discussing portfolio management from CA Final AFM, all concepts, formulae along with solving important questions. So I hope this video kind of helps you and we kind of get done with portfolio, one of the important and almost certain exam questions in AFM. So to start with, for understanding, we need to figure out what is the objective of a portfolio manager and what do you mean by a portfolio. So over here, portfolio is a collection of securities and a portfolio manager is going to have an objective to maximize the return or minimize the risk of his portfolio. So over here we need to understand how do you calculate the risk or how do you calculate the return. Now return for a single security is a fairly easy calculation. You will calculate it as the capital appreciation, that is P1 minus P0, that is price at the end of the year minus price at the start of the year, plus the cash flows that the security gives you, like dividend for a share or interest for a bond. This is the total return, capital appreciation plus, let us say, the dividend divided by the investment. The investment over here is P0. So return for a single security in a single period will be P1 minus P0 plus D upon P0 into 100. Now this is an interesting formula for a single security return for a single holding period. However, if you have to calculate the return over multiple periods, over here, for example, this is the return for a single year. If you want to do it, let us say the return, this is P3 instead of P1, so you are given the price directly after the third year, so P3 minus P0, that will give you the capital appreciation over the 3 years plus the total dividend over the 3 years upon P0. This will give you return over 3 years. On a simple interest basis, you can divide it by 1 plus 1 by n, that is 1 divided by 3. You can also use the compound interest formula. Having said that, at most places institute usually uses a simple interest formula. Over here you can either take 1 by n or you can take, let us say, 12 by m. So that is 12 by 36 months in order to find the per annum return. Now, when we proceed further, you look at the risk. Now, risk is relatively more complex and important as compared to return. One of the crude ways to measure risk can be, let us say, the range. That is the difference between the highest and the lowest values. However, that just takes 2 of the observations in the entire data set, and hence a much more refined measure for risk is called as standard deviation. Now, how do you calculate standard deviation? You will take the deviation from the mean. So x minus x bar. However, some of the deviations may be positive, some of them will be negative. If you total all the deviations, it will become 0. And hence, to remove that and magnify the bigger deviations, which is a cause of a bigger risk, you will do summation of x minus x bar the whole squared. So this is the deviation into the squared, so the number becomes positive, and again the higher deviations are magnified even more, lower deviations, that ways are squared relatively, the squared number is relatively lower. So summation of x minus x bar the whole squared, but that is, let us say, for 10 observations and you divide it by 10. So that will give you the average variance. Square root of that will be the standard deviation. So the standard deviation is calculated, as you can see over here, summation of x minus x bar the whole squared by n square rooted. This is in case there is no probabilities given. If the probabilities are given, instead of dividing by n, you will multiply it by p. So p into summation of x minus x bar the whole squared, and that will give you, let us say, the standard deviation in case probabilities are given. Similarly, the average return when the probabilities are given is going to be summation of p into x. Okay, important considerations: whenever probabilities are given, we will not divide by n, and while calculating we will first square and then multiply by probability. The usual board mass rule, if you are aware, that you will first open the brackets and then you will multiply, divide, as the case may be. Now, a couple of things on special key points which is specific to a few questions, that in case you have been given prices which are come dividend or come bonus, then you will take the price for the return calculation as X prices. So usually the come bonus price minus the bonus element, or the come dividend price minus the dividend element, will give you the X dividend price. So over here we should take the X price because that is the true price of the security for the return calculation. Second, as we have discussed, for a multi-period return, you will do the working as Pn minus P0 plus D and then into 1 by n for simple basis, or you can use a compound interest formula for a compound basis. From institute's perspective, at least in mutual fund chapter, most of the places institute does take this on a simple basis only. Next, you go to portfolio return and portfolio risk. Till now we have focused only on single security return and single security risk. However, we are studying the chapter of portfolio. So for portfolio, you have more than one securities. Let us say there are two securities, in which case the return of the portfolio is a weighted average return, that is weight of A into the return of A plus the weight of B into the return of B. If it is two securities, if there is three securities, then you will also add plus the weight of C into the return of C. The total of weights will equal 1. Now return can be positive, return can be negative as well. And hence we can directly calculate using the weighted average, where weights are the amounts invested at the start of the year. Or if there's a multi-year question, then the market values at the start of the year, that is a value at the beginning, will be taken as the weights. Remember, this is usually the weights are positive for securities which you have purchased. But in rare cases, there may be a case where you have short sold a security, in which case you have not invested money. In fact, on short selling, you would have received the money, and as a result, the weights can be negative in case securities are short sold. Otherwise, the weights are positive. Return can be positive or negative. No further adjustment is needed usually for portfolio return. Now, when you go to portfolio risk, can we also take the weighted average like we did for portfolio return? The problem over here is the portfolio risk includes standard deviation, and standard deviation can be positive, standard deviation can be negative. No, standard deviation can only be positive, return can be positive or negative. And as a result, here there is an inherent positive bias. So there is a possibility that there are securities, two of them, one of them in response to a particular event may go up, like steel prices go up, then the price of Tata Steel might go up, and let's say a company like Maruti, which uses steel as an input, the price might go down because it will reduce the profit. And as a result, there is going to be a deviation in response to a particular event, that is change in steel prices, but that deviation might result in a positive return for or a positive movement for Tata Steel, a negative movement for Maruti. But the problem is, when you look at standard deviation as a number, standard deviation is always going to be positive. And as a result, that co-movement is not correctly captured by standard deviation, and hence we need to make certain modifications. So the formula over here will consider the formula similar to A plus B the whole squared, that is A squared plus B squared plus 2AB. So ideally over here, instead of taking this directly, we would say that, well, this is going to be A plus B the whole squared and then square rooted. One could say that the answer is going to remain the same. Well, generally yes. So my first term will be W squared X into standard deviation squared X, that is like A squared. Second term is going to be W squared Y into standard deviation squared Y, B squared, plus 2 into Wx into Wy into standard deviation X into standard deviation Y. Now, this is where usually the 2AB term ends, but when there is 2AB, there is co-movement. A and B are coming together. In the first two terms, A and B are not coming together. In the third term, they are coming together. And hence, in order to capture that possible co-movement, a correlation XY is multiplied at the end. So this is the crux on why we need that formula, because in the third term, you will actually multiply correlation of XY separately. So when we do the portfolio risk calculation, the risk of the security is going to be calculated by a slightly longer formula. This is for a 2 security portfolio. You can even extend it to a 3 security, that is A squared plus B squared plus C squared plus 2AB plus 2AC plus 2BC. So in each of the case, when you do 2AB, you will multiply it by the correlation of 2AB. When you do 2BC, multiplied by the correlation of 2BC. And when you do 2AC, multiplied by the correlation of 2AC. So over here, this is how you will calculate correlation. And correlation, if you are aware, is going to be between, so the correlation number is going to be between -1 and +1. +1 is perfectly correlated, that they will move in the same magnitude, in the same direction. -1 is perfectly negatively correlated, so they will always move in the opposite direction. So if it is going up, the other security, let us say, will go down, and vice versa. So over here, when you look at the correlation, this formula is the same with the correlation term being multiplied to 2AB to factor in the co-movement. So over here, how do you calculate the correlation? Well, correlation is calculated as covariance divided by the standard deviation of X into standard deviation of Y. Now, how do you calculate covariance? Like, covariance is nothing but similar to variance. In variance, what happens is, let us say you take summation of X minus X bar the whole squared divided by N. If you square root this becomes standard deviation. If you don't square root it, it is variance. So over here it is X minus X bar into X minus X bar. Basically, it is X minus X bar squared. So now, simplistically, if you want to find the covariance, Instead of doing x minus x bar into x minus x bar, you will do x minus x bar into y minus y bar and then divided by n. If probabilities are given, summation of p into x minus x bar into y minus y bar. Now remember, a squared number will always be positive, but x minus x bar into y minus y bar can very well be positive, it can very well be negative. That will give you the actual co-movement at each observation, and then you sum it up. This will, and divided by n, that gives you the average covariance. Now you want to find correlation. Correlation is like over here, so this is covariance. Correlation over here is covariance divided by standard deviation x upon standard deviation y. So in the numerator you have the actual co-movement, in the denominator you will say maximum positive co-movement, because at the end this is standard deviation x is x minus x bar the whole squared square rooted, standard deviation y is y minus y bar the whole squared square rooted. So over here covariance, that is why, is going to be between -1 and +1, because in the denominator you have the maximum possible positive movement, whereas in the numerator you have the actual co-movement. So it will always be range bound between -1 and +1. So over here, when you look at a rearrangement of this formula, you can say that R, that is a correlation. If you take the denominator on the other side, R into standard deviation x into standard deviation y will actually come up and become the covariance. So when you look at the covariance of a security, one of the ways to calculate covariance is summation of, let us say, summation of x minus x bar into y minus y bar upon n. If there's probability multiplied by p, another way would be correlation of xy into standard deviation x into standard deviation y, which is also another method to calculate covariance. Now one needs to remember that once you calculate correlation, which is between -1 and +1, if this correlation is exactly +1, then the number is almost similar to a squared plus b squared plus 2ab, and hence a plus b the whole squared. However, if the correlation is less than +1, it may be 0.5, it may be 0.3, 0.1, or even negative. The moment correlation is lesser and lesser as compared to +1, the third term will keep on reducing and reducing. To some extent, when it becomes correlation is negative, the third term might actually be a negative term, and hence it will reduce the portfolio risk. So as a portfolio manager, a lot of times you try to pick up securities which have low correlation or at best negative correlation. Thereby your overall portfolio risk can possibly reduce as a number. This is called as the benefits arising due to the effect of diversification. Another thing is short selling. Short selling is selling something that you don't have, and in case of short selling, the weights of the security short sold will be negative. Probably the proceeds that you get from the security short sold, we can probably use that to invest in other securities as well, and hence it is possible that there is a situation like weights of x is 1.5 and weight of y is -0.5, but the total of weights will still be equal to 1 only. Next, you have a theory of dominance. It is a big name given, but honestly it is common sense. Theory of dominance means if there are two securities where both securities have same standard deviation, that is a risk, then we'll pick up the security which gives you the higher return, that dominates the other security. Or there are two securities which have same return, then you will pick up the security which has a lower risk. Or between the two securities, if one of them is having a higher return at a lower risk, it will dominate the other security. So this is selection by elimination. You can clearly eliminate a few of the securities which are not worthwhile. Okay, next you go to a 3 or more security portfolio. For return, it will be weighted average. For risk, as we said, it will be a squared plus b squared plus c squared plus 2ab, and you multiply the correlation. To ac, multiply the correlation. To, let's say, BC, and you multiply the correlation. That is it. The more the number of securities, the more will be the covariance or correlation terms, and thereby it will help in reduction of portfolio risk. So over here, this is regarding portfolio risk. Then you have minimum variance portfolio. A minimum variance portfolio, not very important from exam perspective, is a formula given to start with for a 2 security portfolio. In a 2 security portfolio, you will have the weights to be selected in such a way that the portfolio risk is minimized. So how will you select weights in such a way that the portfolio risk is minimized? Well, for finding the weight of x, you will start with the variance of y of the other security, multiply the covariance of xy, subtract the covariance of xy, in the denominator variance of x plus the variance of y minus 2 times the covariance of xy. So essentially you are looking at the individual risk of x and y and trying to find the proportionate element. Obviously, once you find the weight of x, the weight of y is easy, 1 minus the weight of x. Alternatively, you can always try to do the working for y separately, where the weight of y is equal to the variance of x. Remember the other security. For weight of y, you will take the variance of x. For weight of x, you will take the variance of y. All other terms continue to remain the same. Now, the drawback of this formula is it considers a very good starting point, that is weights of two securities in such a way that the risk is minimized. But when you do portfolio investment, you are not only going to look at risk, you are also going to look at return. And hence the drawback of this formula is it does not consider return. So in practice, you will look at this as a starting point and then try to find an appropriate way in which you can find, let us say, the portfolio which also optimizes for your return. Okay, next you have modern portfolio theory. So when you are looking at the theory that we just studied, that was given by Harry Markowitz. So sometimes the institute tells you calculate the standard deviation using Markowitz formula. So this is the Markowitz formula, remember. However, this is a traditional formula for finding standard deviation and the portfolio risk. Next, modern portfolio theory is given by William Sharpe, and William Sharpe decodes, he kinds of breaks down the risk into two parameters between systematic and unsystematic risk. So the essence of William Sharpe is that you should not necessarily demand compensation for blindly bearing a risk. The risk may have systematic factors, that is undiversifiable. No matter what you do, you bear that risk. Like the risk of a war, the risk of high inflation, the risk of higher tax rates. No matter how well you are diversified, you are going to bear that risk. Or there are certain risks which are undiversifiable, or there are certain risks which are diversifiable. Like you might invest in a company and there's a death of a CEO. Now that security's price might go down, but their competitor's price might go up. Or there might be labor strike, again in which case that company's price might go out, but the demand will shift to another company and their price might go up. So unsystematic risk is diversifiable risk, and if you're holding a fairly diversified portfolio, unsystematic risk can be theoretically eliminated, practically substantially reduced. So William Sharpe says that your total standard deviation that you calculate for an individual security will consider every deviation, whether it is coming out of a systematic factor or coming out of an unsystematic factor. However, if you want to truly compensate an investor for bearing a true level of risk, that is systematic risk. Unsystematic risk can be diversified away. If you are inefficient and you are not diversifying, you should not expect the market to compensate you for that. So the base of William Sharpe's theory is that an investor should be compensated for bearing what is called as systematic risk, and systematic risk is undiversifiable risk. Okay, now how do you measure systematic risk? William Sharpe uses a concept of something called as beta, and then uses that beta to calculate required return very beautifully using of CAPM formula, that is capital asset pricing model. Now this is arguably one of the most important formulas and one of the most commonly used formula in the world of finance. So when I look at this formula, CAPM, what does this formula say? KE, that is the required return, minimum required return, is a function of what? RF. RF is a risk-free rate. Risk-free rate of similar government securities similar to your holding horizon. So when I start investing in a portfolio, I would say that minimum I need a risk-free rate. I need more than that, but at least risk-free rate should be met. So that is a base. Risk-free rate plus RM minus RF. This is the equity risk premium. So if my government bond is giving me 10% and Sensex is giving me 15% or Nifty is giving me 15%, I'm saying that now I'm moving from a risk-free setup to a risky setup, and hence 15 minus 10, that is equal to 5, is the premium that you should expect on an average if I move to equity. But I am not investing directly in Nifty. I'm investing in a particular stock. Let us say like Maruti Suzuki. Now Maruti Suzuki has more risk as compared to the market because it is much more volatile. Like if the economy is doing well, people are going to buy much more cars on an average, whereas it is going down, the first thing that they will cut down is cars. And as a result, the responsiveness of Maruti to overall market movements is going to be greater. And hence you measure it by something called as beta, which shows the responsiveness of your security to movement in the overall market. So let us say the beta over here is 2 times, in which case you will say 10 plus 15 minus 10 plus 2, so that is approximately equal to 20%. So this is your required rate of return for a company like Maruti Suzuki Limited. If you are investing in Nifty, you should be happy at 15%, but you are investing in a product which is more volatile, more risky as compared to Nifty. and hence you should expect 2 times the equity risk premium. Remember, there's no logic expecting 2 times the risk-free rate. So we are saying that 10% you would have got irrespective, even if you took 0 risk. So the compensation for bearing risk is 5, and you are bearing twice the risk as compared to market, and hence you are going to expect 10 plus 10, that is equal to 20. On the other hand, there is another company like Colgate. Now Colgate is much more defensive in the sense that even if the economy goes up or down, people are not going to consume more of toothpaste in general, and as a result over here the responsiveness of Colgate, let us say, is 0.5. So over here I might say that if I'm moving to equity, I should expect 5% more as compared to the risk-free rate. But I'm investing in a company which is less riskier on an average, and as a result, I'm happy probably getting a 12.5% return for Colgate. And hence, what I'm trying to do is I'm trying to measure my required return based on the risk. So William Sharpe beautifully builds that bridge between risk and return, where higher the beta, that is higher the risk, higher will be the required return, lower the beta, that is lower the risk, lower will be the required rate of return. And as a result, CAPM comes out to be one of the most popularly used formulae for calculating KE in the world of finance. Now for CAPM, RF is based on the based on the risk-free rate from government bonds. RM is based on a fairly widely diversified market portfolio like Nifty or BSE 500. And beta, how do you calculate beta? Now there are multiple formulae to calculate beta. However, conceptually, beta is nothing but the systematic risk of the security, upon the systematic risk of the market. Remember, market is fully diversified, and hence any unsystematic risk has been eliminated from the market. So the standard deviation M, that is the risk of the market, total risk, will be very close to the systematic risk of the market. However, risk of the security, when you look at standard deviation S, that represents the total risk of the security. Now security might have some unsystematic risk. So how will I find the systematic and unsystematic element? So William Sharpe, and again this is arguable whether this is correct or not, but William Sharpe says that if I want to find the systematic risk of the security, I will take the total risk of the security, that is standard deviation S, and I will say that, well, if the standard deviation S is, for example, 30%, that means the security has deviated 30% from its average. However, I will try to find a correlation with the market, because I believe that the market is moving only due to the systematic factors. So let us say the market has a standard deviation of 15%. So I might say that over here there is 30% risk of the security upon 15%. That is the risk of the market. So your security apparently appears to be twice as riskier as compared to the market. Now market in the denominator is fully diversified and hence theoretically has only systematic risk, but in your numerator the individual security may not be fully diversified and as a result may bear some unsystematic risk. So how do you quantify that? It is very difficult to quantify that, and hence Sharpe says that let us try to find the correlation of the security with the market. So let us assume the correlation of the security with the market is 0.7. Loosely speaking, that means that 70% of the times, 0.7, the security moves in tandem with the market, and hence the remaining 30% of the times the security movement is not in line with the market. And as a result, the William Sharpe theory says that you will take the standard deviation S upon standard deviation M, that is total risk of the security upon total risk of the market. In the denominator you don't need to make any adjustment for systematic, but in the numerator you will multiply it loosely by the correlation of the security with the market, so that in the numerator you will get the deviations which were happening when the market was also deviating, loosely speaking. And as a result, beta over here is calculated as correlation of the security with the market into standard deviation of the security upon standard deviation of the market. Institute usually calls this formula as a correlation method, formula using correlation method. You can even improvise on this formula, where you can say correlation is nothing but covariance upon standard deviation of S into standard deviation of M. Now once you find that, this standard deviation S and this standard deviation S will get cancelled, and thereby your answer will be covariance of S by M upon variance of M, and thereby that is another formula. Remember, this is not a different or a new formula, this is the same formula. Either of these formulas can be called as derivation using the correlation method. Most of the institute's older sums, if you go to see, have been solved. 90% of the sums have been solved by this formula only. Now there's one particular sum in the study material and one particular sum in the exam, which institute has solved using a slightly different formula, which they call as a regression method. Now to be honest, the final answer that you get in this formula or the other formula is going to be same subjected to a certain degree of approximation which is accepted. So in the exam, which one should you do? Whichever you are more comfortable. There's no way in which you can predict the formula that the institute is going to take. The second formula is the regression formula. We have also uploaded a video called as alternative method to calculate beta for this particular concept, I think a year or two back. So over here, what do we say? In this case, in this formula, regression method says that beta is calculated as summation of x into m minus n into x bar into m bar, and denominator summation m squared minus n into m bar squared. So unfortunately you will have to remember this, but if you want to understand it to at some level of understanding, you have to remember that in the numerator you are doing summation of x into m. X into m is similar to doing something like covariance. Over here also x bar into m bar. So you are looking at x and m, so it is similar to covariance of x and m. But in the denominator, when you are looking, instead of x into m, you are doing m into m. So this is only market. Again, instead of doing x bar into m bar, you are doing directly n into m bar squared, and hence in the denominator you are looking at it like as if it is a variance of the market. So loosely speaking, this is a formula which will give you almost the same, or rather exactly the same, subjected to certain approximation, answer as this correlation method. If I have to solve using the correlation method, typically the columns that I will use while doing the calculation would be, I will take, let us say, security x, I will take security y, below I will calculate x bar, I will calculate, let's say, instead of y, I will take m, that is a market, I will calculate x bar and I will calculate m bar. Once I do that, I will first try to find the covariance, which is p into x minus x bar into m minus m bar. So I will do the covariance workings. Once I find the covariance, I will do x minus x, p into x minus x bar the whole squared, another column for p into m minus m bar the whole squared. And with that, you will have all the data to find covariance, to find variance of a security, variance of another security, and standard deviation as required, and you can find the beta. In the second case, again, you will do x, you will do m. Now rather than looking at covariance, you will make a column of x into m and you will make a column of m squared. And that ways you will do the working. Now this is typically a little more faster, but for this you need to do practice. Again, most of the sums that you will refer, except for two exact sums, one is in the main exam and one is, I think, in the study material. Except for these two sums, everywhere the institute has used the correlation method, but for these two sums the institute has used the regression method. Answers are approximately the same by either of the methods, so I think in the exam either of these should ideally work. Okay, next you look at, let us say, the key points. For risk-free security, the beta will be 0, covariance with anything will be 0, correlation will also be 0 because it does not deviate, because it is risk-free. But for the market, beta will equal to 1. In certain cases where return on market is not given, then how will you solve? First, you will look at if prices of the market are given, then you will do P1 minus P0 plus D upon P0 into 100. So this will give you the return of the market. Sometimes the market return dividend yield is given in percentage. Remember, for market there is no face value. So if the percentage is given, it is a percentage of the market price. Second, you might be given a list of securities, and from that you have to determine the market. We will assume that if there are more than 2 securities, then all the securities together, including even the government securities, will constitute the market. So if more than 2 securities are given, assume all securities together constitute the market and accordingly try to find the market return. But if exactly 2 securities are given which are efficiently priced, you can use simultaneous equations, and you can say that if these 2 securities are efficiently priced and I have the return for these 2 securities, I can infer and try to find the market return using CAPM simultaneous equations. So you can understand this better through practice, but these are a few ways in which market return can actually be inferred. Okay, there is a conditional shortcut for calculating beta. Like there was a conditional shortcut also to calculate portfolio standard deviation. Like if the correlation is +1, you don't need to do that big formula for portfolio standard deviation. You can directly say standard deviation of portfolio XY is weight of X into standard deviation X plus weight of Y into standard deviation Y, because correlation is +1. When you look at beta, conditional shortcut for beta, when exactly 2 return observations are available. This is only if 2 return observations are available. So let's say for a security, it is 4% and 20 2%, that means the change is 18%. At the same time, the market had changed, for example, from 9% to 18%, in which case we can say that for exactly two observations, when the market changed by 9%, your security changed by 18%, and hence you will take 18% upon 9%, loosely speaking, that will give you the beta of 2 times. This is only if two observations are available. This method does not work if more than two observations are available. Then you go to the concept of portfolio beta. Portfolio beta refers to weighted average beta. You will not do squaring, square rooting, etc. Why? Because within beta can very well be negative, and any unsystematic risk, if any, has already been eliminated, and hence when you construct the portfolio, there can be no further elimination. So your beta will be the weighted average beta, that is beta xy will be weight of x into beta of x plus the weight of y into beta of y, and that will give you the portfolio beta. Now there are various types of lines. There are three types of lines. One is a security market line. Security market line is nothing but a graphical plotting of the CAPM. On one side you plot the return, the other side you plot the risk, which is a beta, because CAPM is a base. Security market line is an upward sloping line. It is a graphical presentation of CAPM. So at the beta of 0, you will still earn risk-free rate. So it starts at RF and goes upward. You can plot another point like 1, RM, and the line will slope upwards. It will be a linear line, because the risk keeps on increasing, the return also increases by the same proportion. It is upward sloping because higher the risk, higher the beta, higher will be the return. So over here, this is nothing but a graphical presentation of CAPM, and efficiently priced securities fall on the CAPM. Securities which are undervalued will actually plot above the CAPM because their actual return is greater than what is required. Securities which are overvalued will plot below the CAPM because their actual return is less than what is required. Okay. Next, you have something called as characteristic line. Now in characteristic line, you will have the characteristic of beta. So on one side you plot the return, on the other side you plot the market. So you will compare the securities return with that of the market. Here you will try to find what is called mathematically and statistically as a line of best fit. So over here you will try to find a characteristic line. The equation of a line is generally x is equal to a plus by. This is equation of any line. X is equal to a plus by. But how will you find a over here? How will you find y over here? So over here you use a regression concept. So under the regression concept, let's say market is an independent factor, security is a dependent factor. So if I look at the regression equation, it is, let us say, y minus y bar equals a regression coefficient into x minus x bar. Now x over here is an independent factor, y over here is a dependent factor. So let's say y is similar to a security. So this is s minus s bar equals a regression coefficient. Regression coefficient is beta into m minus m bar. This is independent. So if I open the brackets, this will be s minus s bar equals to beta m minus beta m bar. So I will take s bar on the other side. S is equal to s bar minus beta m bar. Remember, s bar remains the same for all the 10 observations if you have. M bar remains the same for all the 10 observations you have, and beta also remains the same. So these are constant terms, and this will be called as alpha plus beta m. Now beta remains the same, but m keeps on changing. So your characteristic line is s is equal to alpha plus beta m, where alpha is equal to s bar minus beta m bar. So if possible you can remember it. If not, you can probably remember how we calculated, and hence you can kind of infer what your alpha would be. Now alpha, eventually you will see there are two alphas. One is Jensen's alpha and one is alpha under characteristic line. Hopefully the institute should be clear on which alpha they are asking. If not, it is preferable that you solve both the alphas and show to the institute. So over here, that is characteristic line. There is also capital market line. The capital market line is for an investor who is not efficiently or fully diversified, and hence does not treat beta as a measure of risk. In fact, that investor treats standard deviation as a measure of risk. So the formula for CAPM remains the same: RF plus RM minus RF, usually into beta. But beta is calculated as a correlation of security with the market into standard deviation of security upon standard deviation of market. Now I am not treating systematic risk to be a true measure of risk, and hence for me my formula will be basically RF plus RM minus RF into standard deviation S upon standard deviation M, and this would be called as the capital market line. Over here, in this case, the constant terms would be RM minus RF upon standard deviation M. This is called as the reward to risk ratio of the market. In the numerator, that is the reward of the market. In the denominator, there is the risk of the market. This is also called as the slope or the rate of change in the CML. There is also another concept called as critical line. Again, the equation of a line will be X is equal to A plus BY. That is general equation of a line. Next, you go to the concept of systematic and unsystematic risk. Now, we have discussed about systematic and unsystematic risk in theory terms when we discussed about CAPM. However, if you want to quantify the systematic and unsystematic risk, how will we do that? Well, one will say that systematic risk of a security is nothing but the numerator of the beta calculation, which is perfect. So, if I look at the beta calculation, beta is equal to correlation of S into the security into the market into standard deviation of the security. When I divide it by the standard deviation of M, I am dividing it by the risk of the market. But if I want to find just the systematic risk of the security, I will take correlation S M into standard deviation S. This will give me the systematic risk. Okay, remember the entire beta formula you divided by the market. Alternatively, if I take this on the other side, it will also give me the same numerator of the beta. So basically, one of the ways to calculate would be beta into standard deviation M. Other way to calculate, which is the same as correlation of security with the market into standard deviation S. Now, this is how you technically calculate systematic risk. But the problem is, whenever you see any institute solution where they have asked to calculate systematic and unsystematic risk, you will always see that these calculations are done in squared terms, and hence a student is typically confused that why is there a squared terms. It is because your total risk, that is standard deviation, is equal to the systematic risk plus the unsystematic risk. So let us say the total risk was 25, that is the standard deviation, equals to the systematic risk, let us say this is 9, plus the unsystematic risk, that is equal to 16. So when I square root 25 on both sides, I will square root 9 and 6 together. I cannot say, so this will give me the right answer, but I cannot say that the square root of 25 is equal to the square root of 9 plus the square root of 16. This will not work. And hence, sir, we are not understanding what we are trying to say, of course. So over here, what I am trying to say is, when we look at questions where you are asked to calculate unsystematic risk. Now, for unsystematic risk, let us say, if you square root 25 and come to standard deviation, if you square root systematic risk and come to the systematic risk number, you will get a wrong answer. As we had said, that root of 25 cannot equal to the root of 9 plus the root of 16. I cannot individually square root the systematic and unsystematic risk, and as a result, what I do is I will keep everything in squared terms, and then if required, I will square root it. So I will say 25, that is the total variance, that is a standard deviation squared, that is the total risk of the security. From this, I want to reduce the total risk minus systematic will give me unsystematic. So over here, from this, I will reduce maybe beta squared into variance of the market, or I will reduce correlation squared into the variance of the security, and that will give me my desired answer. That is the unsystematic risk, which is also in squared terms, and if you square root the unsystematic risk that you have now calculated, that number is called as a random error. But you will first have to find the unsystematic risk by taking the total risk as well as systematic risk in squared terms. So if you, long story short, if you want the answer on why the institute has kept the systematic risk in squared terms whenever it is asked, it is because in almost every question that it is asked, along with systematic risk, you also have to find the unsystematic risk. And that is, unsystematic risk is calculated as a balancing figure. There is no formula. You can find the total risk, you can then find the systematic risk, and then the balancing figure will give you the unsystematic risk. And as a result, when you find the unsystematic risk as a balancing figure, this is going to be, let us say, a squared term. And hence you will first find it as a squared term, and then you will square root it if required. So this is a fairly important thing, that if you are asked to calculate systematic and unsystematic risk, we need to leave them in squared terms only. A few important formulae that can come from this particular understanding. Well, there are at least three. In fact, there is actually a fourth method as well. Methods to calculate covariance. So first is the standard method, summation of x into x bar into y minus y bar divided by n. The first method. Second is you rearrange the correlation formula. correlation into standard deviation X into standard deviation Y. And then there is a new formula. So this is the new formula that we will study over here. That is beta X into beta Y into variance of the market. So this is nothing but beta X into beta M. That is like the standard systematic risk of X, and then beta Y into standard deviation M, which is largely the systematic risk of Y. And as a result, you are trying to find the covariance. We have done derivation for this as well, but right now it is not required. It is important that you kind of remember the formula. This is the third formula for beta. When do we use this formula? Well, if data regarding individual securities is not given, that data series is not given, or correlation data is not given, standard deviation data is not given, but you have beta and variance of market, in which case you can use this formula to find the covariance. Another formula to find the covariance is nothing but this formula. This numerator over here, this was nothing but similar to covariance. So over here, your covariance can also be calculated, let us say, as a fourth method, which is summation of X into M minus N into X bar into M bar. Now this will give you the numerator divided by N, and that will give you, let us say, the covariance. That is also a possibility, because this is nothing but covariance divided by variance of the market. So in the numerator, what you have is covariance, though institute has not particularly used it anywhere. Okay, second is an alternative method for portfolio risk. Now this is called as the Sharpe's method. So earlier we calculated portfolio risk using Markowitz method. So unfortunately, you will have to remember their names as well. The traditional portfolio standard deviation formula, which looks at standard deviation and correlation, is the Markowitz formula. Sharpe, on the other hand, looks at systematic and unsystematic risk. So Sharpe says that portfolio risk can also be calculated by taking portfolio beta. So it says that you first find beta of XY and into the variance of the market. Now beta squared into the variance of the market will actually give you the systematic risk of the portfolio. Plus you will look at unsystematic risk, let's say the error term of X into, let us say, the weight squared of X plus the unsystematic risk of Y into the weight squared of Y and square rooted. This will give you systematic risk of portfolio plus unsystematic risk of all the securities in the portfolio, and that total is also going to give you, we have shown the derivation below, that is just for your understanding, that will also give you a standard deviation number, which for all practical purposes can also be considered to be your portfolio standard deviation. Your answers will be the same if you do it properly under both the methods. Okay, then there is performance evaluation measures. This is more relevant in mutual fund chapter. There are three core performance evaluation measures, where first is the Sharpe ratio, where you take the reward in the numerator, return of a security minus the risk-free rate upon standard deviation of the security in the denominator. Turner ratio, again reward in the numerator upon the beta. So typically Sharpe ratio is more suitable for portfolios in general. Turner ratio is useful for portfolios which are known to be fully diversified. Now there is another method called as Jensen's alpha, where you compare the actual return and the required return. So if you are able to outperform what is required, then that is considered to be an outperformance called as alpha. Now when you look at these ratios, if nothing is given, if you have to evaluate the portfolio, the best method to evaluate is treated to be the Sharpe ratio. Why? We generally would end up, if you don't understand the logic, you will generally end up saying that Sharpe ratio, Sharpe invented beta, so Sharpe would have Rx minus Rf divided by beta. But that is actually Turner ratio. Now Sharpe said that yes, beta is a measure of systematic risk and that should be used. However, now I'm doing performance evaluation. I'm looking at 10 different mutual funds and seeing that which of them is best. So I don't know whether they are efficient and they're fully diversified. If they have not fully diversified, the standard deviation will be higher. If they have diversified, the unsystematic risk would have been eliminated and standard deviation would be lower. So I need to gauge that. I cannot assume that the investors are efficient now. I need to check whether they are efficient or not. And if they are indeed efficient, the standard deviation would have been falling because they have adequately diversified. If they are not efficient, the standard deviation will probably be higher. And hence, when it comes back to performance evaluation, Sharpe now takes a U-turn and says that for performance evaluation, you should ideally gauge based on standard deviation, and as it goes, generally we worship Sharpe, and hence if Sharpe is saying that we should take standard deviation, we preferably take standard deviation. The concept over here is we also test in the denominator whether the portfolio is efficiently diversified or not for performance evaluation, and hence it's a better ratio. Okay, there can be other measures as well, but these are usually the common measures. Next, you move out of modern portfolio theory. So earlier you had the traditional theory of Markowitz, then we moved on to the modern portfolio theory of William Sharpe, and then people, anything new that comes is fancy, and then people start to criticize it, and then people try to kind of find their own version. So similarly over here, there was Stephen Ross and a few other people who said that CAPM is good, but it is focusing only on one factor. However, in practice, a security's required return should not just be influenced by one factors, but by multiple factors. Like I may be, for example, I may be, let us say, an education company or an infrastructure company or an IT company. For everywhere, the RM is the same. And we are mapping that RM with the beta. Now, return on the market might change due to various systematic factors like interest rate changes or exchange rate changes. Now, if I am predominantly a domestic company, for me the exchange rate change does not matter. It will matter for the market in general, but for me it does not matter. Or if I am an education or a IT company which does not have any debt, for me the interest rate change also does not matter significantly. But for an infrastructure company which has a lot of infrastructure related loans, interest rate changes do matter, and hence they say that we should try to break down the market and try to find the sensitivity of your security individually to factors to which you are sensitive and to which you are responding. And hence over here what we try to do is we try to find the relevant factors for a security. Maybe 4 or 5 factors, there's no list. Maybe inflation, maybe GDP, maybe industrial production, maybe anything, and try to find the oil prices, exchange rates, try to find the sensitivity of your security to the movement in the overall market. Movement of your security, responsiveness of your security to the overall movement of that particular factor, rather than taking market as the only factor. Remember, market can be the factor. Like for a brokerage firm like Zerodha, for example, market is an important factor. If the market is going up, Zerodha is also performing relatively well. However, market cannot be the only factor, and hence you have arbitrage pricing theory, also called as multi-factor models, where you kind of use CAPM base and say KE is equal to RF plus lambda of factor 1. Lambda is a premium. It can be, let's say, factor 1 is, for example, foreign exchange. So FX, return of dollar minus the risk-free rate into, you will try to find the beta of your security to foreign exchange. Like if you're a company like Infosys, if the exchange rate appreciates, in the sense if the dollar goes from 80 to 90, 95, being an exporter, it is favorable for you. Whereas if you're an oil importing company, if the exchange rate appreciates, it is adverse for you. So you can try to find the sensitivity in the same way like you do for market. So instead of taking the market daily return, you will take dollars daily return and compare it with your stock return. And you will not just do it for one factor, you will do it for every factor, and hence this is an open-ended formula. You see dot dot. So theoretically this formula is very superior. However, practically this is a formula which can be subjected to manipulation, and hence you can select the factors that you like and hence manipulate the KE, and hence it is not as popular. There is also another variation of this formula, that instead of taking the risk premium, that is lambda, you take the surprise element. Stephen Ross, for example, said that what moves the market is not necessarily the actual return. What actually moves the market is the surprise element. So if you are expecting to grow at 20%, like HDFC was expected to grow at 20%, it grows at 17%, which is significantly higher than everyone else, but still HDFC stock falls. Why? Because it is not growing as expected. So as per Stephen Ross, the factor that should be looked at is not necessarily the return of that factor minus the risk-free rate. The factor that should be looked at is a surprise element, and the working should be done based on that. So in the exam, how will we know what to take? Well, it depends on the data. If data in the question is given for expected as well as actual, you can take the surprise element. But if expected data is not given only, then the only way you can solve is this, because you will almost certainly be given the risk-free rate, and then R of that factor minus the risk-free rate will, let us say, give you the lambda. Uh, it's a fairly interesting concept, but usually institute usually does not ask you enough on this. There have been a couple of questions asked. Now one needs to remember that here there are multiple factors. Let us say there are 3 factors. Then there will be 3 separate betas, and hence there will be 3 separate portfolio betas. The formula over here is the same. Weight of a security into the beta of the security to a particular factor plus the weight of another security into beta of the other security to that factor, and so on. So as many factors are there, that many portfolio betas will be there. So there may be, let's say, 4 factors, and there may be just 2 securities in your portfolio. When you calculate, there will be 4 different portfolio betas because there are 4 factors. So it will show the responsiveness of your portfolio to each of those 4 factors. You will need some practice over here. We will also be doing a sum. Then there is this concept of Sharpe's optimal portfolio, for which your study material has 1 sum. We have taken 2 sums for solving, but having said that, Sharpe's optimal portfolio has not made it to the exam because of the intense calculations required. But nevertheless, for a quick discussion and revision in case of Sharpe's optimal portfolio, this is kind of a master guide where Sharpe tells you that which all are the securities to be selected and in which proportion are those securities to be selected. So what Sharpe does over here is, Sharpe tries to calculate if you have a universe of, let's say, 10 securities. Sharpe says you calculate the reward to risk ratio for each of the securities, that is Rx minus Rf divided by the beta of x. Find the reward to risk ratio of each securities. Second, you rank those securities in the descending order, that is highest reward to risk comes first, lowest reward to risk comes next. And third, for each security you try to find a cutoff point. Now this calculation of cutoff point is a fairly intense calculation where for each level you will try to find variance of m into the cumulative of Rx minus Rf upon the unsystematic risk into beta upon 1 plus variance of m into the cumulative of beta squared upon the unsystematic risk squared. Now this is a fairly detailed calculation and will require practice. You do these workings for each of the securities and reach a point where you touch the highest cutoff point. So there may be 7 securities, 10 securities. Cutoff points will keep on going up and up and up till the time they reach a particular peak, and then they will go down and down and down. If you have a wave pattern up and down, it is wrong. This is requiring practice. So this security which is at the highest cutoff point, let's say this comes at security number 4, in which case you will select the 4 securities as a part of your portfolio. That is your optimum portfolio. However, you don't know what is the weight to be given to each of the securities, so Sharpe makes your life even more miserable. Sharpe says that you will try to find Z for each of those securities. If you have 4 securities, for each of them find the Z. Z is calculated as beta of that security upon the unsystematic risk of that security into the reward to risk ratio of that security minus the final cutoff point. So whatever is the final cutoff point value that has come over here, you will take that and find the Z of each of these securities. Then the weight would be, let's say if there are 4 securities, weight of the first security is the Z of the first security upon Z of 1 plus Z of 2 plus Z of 3 plus Z of 4. And accordingly, you will try to find the weights. Now if you have practiced this and it comes in the exam, you can try this. If you have not practiced this, you can kind of take a chance because it has never come in the past in the exam at least. And then you come to the last part. This part over here is kind of dispersed. Various questions from this part come in the merger section, in the business valuation section, in the portfolio section, and also in the international financial management section. This pertains to private company valuation. So when we look at private company valuation, how will you do valuation, let us say, for a private company? Well, we will say that the valuation happens usually taking the present value of future cash flows. So you'll predict the future cash flows of the private company, and now when you go to discount it, let us say for this company you need to find discounting factor, that is K is equal to RF plus RM minus RF into beta. Now the problem is we have taken beta for granted and we have assumed that we will be able to find the beta. Well, you will be able to, provided your security is listed, and hence it is able to give you a correlation with the market as well as a standard deviation with the market. But if I am a company like Parley, for example, which is unlisted, I cannot really calculate beta for an unlisted stock, and hence what do? Well, I will have to go to a series of steps where I will first identify a proxy company like Britannia or a set of proxy companies or an industry. Once I do that, I will try to find the equity beta of that company. I'm saying that this company is similar to me, but in my operations. However, I might have different financing structure, that is debt and equity. They might have a different financing structure. And as a result, I will first try to find what is called as the unlevered beta. Unlevered beta is a pure asset beta. Like over here, I will first find an equity beta for a proxy company. I cannot blindly take that for me because that proxy company like Britannia has the same business risk of biscuit industry that I have if people become health conscious, etc. But it does not have the same financial risk that I have. Maybe they have lesser debt, maybe they have more debt as compared to me, and hence the actual risk that an equity shareholder bears for both companies might be different. So what I will try to find is, let's say I have the equity beta, I will use that to find the asset beta. A formula over here is very similar to the WACC formula, like the cost of debt into weight of debt plus the cost of equity into weight of equity. Here you take the beta of debt into the weight of debt plus the beta of equity into the weight of equity. Now the thing over here is, so this will give you the beta of overall or beta of assets as a whole or company as a whole. Now the thing is, unless given otherwise, you can assume that the beta of debt is equal to 0. Debt usually does not really respond to changes in the market. The beta of debt, let us say, is 0. Sometimes the beta of debt can also be given, in which case you will take it, but otherwise the beta of debt can be taken to be 0 into the weight of debt plus the beta of equity into the weight of equity. So if beta of debt is 0, this entire term essentially will become 0 only, and hence the overall beta typically gets calculated as beta of the assets will equal to the beta of equity into equity upon debt plus equity. Now the thing over here, and this is what the formula states, is that what if there is a tax rate? Typically, when you calculated WACC, the tax rate was adjusted in the workings for debt. However, this debt has been eliminated. I mean, in the sense, it is virtually risk-free. So there is no interest calculation per se. So wherever there is D, that is debt, you will do into 1 minus D. So basically, your formula will be unlevered beta, also called as asset beta, company beta, various names, will be beta equity into equity plus debt plus equity, assuming beta debt is 0 and assuming there is no tax rate. If tax rate is given, then D will be multiplied by 1 minus T, as you can see over here, in case tax rates are given. Now step 1 was finding the proxy company. Step 2 would be to find the asset beta of Britannia. Now step 4 would say that, well, asset beta is like the business beta. Now the business beta for Britannia as well as Parle will remain the same, because they have the same business risk, and hence the asset beta of Parle and asset beta of Britannia should ideally be the same. However, the debt to equity of Parle would be different from debt to equity of Britannia, and hence in the third step you will try to find something called as a relevered beta. So you will say that, let's say if the asset beta is 0.95, this will equal the beta equity of Parle, which I don't know, into equity of Parle that I know, plus debt into 1 minus T of Parle, plus equity into Parle. I know the debt to equity structure of Parle, and as a result, if let us say Parle has a 1:2, or let's say 2:1 debt to equity, then 0.95, which is the asset beta, equals to beta equity into, let's say 2:1, so 1 upon 2 into 1 minus, let's say tax rate is not given, plus equity. So therefore 0.95 into 2 plus 1, that is 3 upon 1, will equal to the equity beta. So institute sometimes shows a separate formula for relevered beta, something like this. So over here, this is nothing but 0.95 into, like we did, equity weight plus debt weight into 1 minus T upon equity weight. It is the same thing. So if you can't remember this formula, remember that it is nothing but a rearrangement of your core formula only. And once you find that, that is an equity beta which you can use for CAPM if you want to find the cost of equity. Sometimes you want to find the WACC. So traditionally WACC should always be calculated as the cost of debt into, cost of debt is interest into 1 minus T into the weight of debt plus cost of equity that you have calculated here into the weight of equity. But sometimes the data for all of this is not available, like cost of debt, etc. is not available. Then another alternative way to find WACC can be to use the asset beta. Now asset beta is for the company as a whole, and hence if you want to find the WACC, I can use the same formula RF plus RM minus RF into the unlevered beta or the asset beta, and hence that will give you the WACC. So hopefully this gives you some perspective. The terms over here are a little taxing. Unlevered beta is similar to asset beta, that is like WACC for debt and equity both, whereas relevered beta is like equity beta, that is, for example, used for the base of KE. If you practice this, you will get a better understanding. But let's say in approximately an hour, we have tried to review everything that is possible for portfolios. Now we can try to go to the question. There are 10 odd questions in your Super 90 file, which we have shared on Telegram. So let us try to do as many as possible. Let's get started then with the questions on portfolio. So let us go to question number 1. This is on calculation of portfolio return. So X invested on 1st April 2005 in certain equity shares as below. So you have M, where total investment is 2 lakhs for 1000 shares, that is approximately cost of 200 per share, and 1 lakh 50 for 500 shares, that is approximately a cost of 300 per share. In September 15 or September 2005, 10% dividend was paid by M, and in October 5, 30% dividend was paid out by N. Okay, so dividend, remember, is always a percentage of face value, and as a result over here we can say that if my total investment in face value is 1000 into 100 and this is 5000 into 10, dividend is a percentage of face value, that is going to be 10 rupees, that is going to be 100 rupees. 30% on 31st March 2006, market quotation showed a value of 220 and 290 per share of M&N respectively. Okay. Now on 1st April 2006, that is the next year. Now this was for 2005. Now you go to 2006. Investment advisors indicate that dividends from M and N for the year 31st March 7 are likely to be 20% and 35% respectively. And the probabilities of quotations are as follows. So you have the price which is quoted for shares of M and N. You are required to calculate the average return for the portfolio for the year ended 31st March 6. So this is for the first case, and then expected average return for the year 6-7. So this is the expected coming year. Advise X company of the comparative risk in the two investments by calculating the standard deviation in each of the cases. So over here you want to calculate the standard deviation as well. So first I will go to the first year. I want to find the return of the portfolio. Portfolio return is weight of M into return of M plus the weight of N into the return of N. So I can easily find the weight of N for the year 2005-6, that is 2 lakhs and 1 lakh 50. So that is the total of 3 lakh 50. So this is what? 20 is to 15, that is 4 is to 3 is going to be the weights. But now if I want to find the let us say find the return, how will I do that? Return for M will be P1, price at the end of the year is 220, minus P0, 2 lakhs by 1000, that is 200, plus dividend. Dividend is given to you as 10% of 100 rupees face value. So this is 10 divided by 200. So this probably comes to around 30 divided by 200, that is 15%. The return of N done in a similar way would be the price is 290. Initial price was 300, so there is a loss. Plus there is a 3 rupees, 10 rupees into 30% dividend divided by 300, and hence there is a negative 7 divided by 300 comes to around 2.33% negative. Can the return be negative? Well, why not? The return can very well be negative, and hence 15% and a negative 2.33% will be taken. So if I want to find the weighted average return, so you'll have the return 15, 2.33 and weights 20 by 35, 15 by 35, weighted average will come to around 7.57. That is the first part. Second part over here says calculate the expected average return for the portfolio for the year 6-7. Now in the year 6-7, you have a series of price. So you will say what is the weighted average price? 220 into 0.2, 250 into 0.5 and 280 into 0.3. And hence this comes to approximately 253. Similarly, if I do this working over here, this probably comes to around 312. So if I want to find a return, one of the ways would be 253 minus 220 plus the dividend is 20%, 20% of 100 comes to 20 divided by 220. So if I go to see 253 minus 220 plus 20 divided by 220 in percentage comes to 24.09. In a similar way, we do the working for N, and probably you will get around 8.79, and thereby you will find a weighted average return. But here, what is the weights? Now, a student will say that the weights will remain constant. that is 20 is to 15, and this is where you will possibly make a mistake. Remember, the weights over here are going to be based on the values at the beginning of the year, and the values, let us say, at the beginning of the year are going to be 1000 into 220 and 500 into 290, so that is 2,20,000 and this is 1,45,000, and hence the weights will be calculated accordingly. The values at the beginning of the year, because the return is based on the price at the start of the year, the weight should also be based on the price at the start of the year, and accordingly you will try to find the weighted average return, which is coming to around 18.01%. So this is the second part. Then the last part of the question says you want to find a standard deviation. Now remember, standard deviation requires a series, and series is not there in 2005-6, it is actually there in 2006-7. There is so many possible values, and hence we will try to find the deviation based on the data of 2006-7. You look at the data of 2006-7, where you can probably try to find the return at each level. So 220 minus 220 plus, let us say, 20 divided by 220, so you will find the return at the first level, 9.09, then return at the second level, then return at the third level. So for standard deviation, you can either take the prices or preferably take the percentage returns. You find the percentage returns at each level and then try to find the standard deviation. So how do you find the standard deviation? X minus X bar. So you will try to find the X bar, which is 24.09 and 8.79, X minus X bar the whole squared. You will do X minus X bar the whole squared working, and Y minus Y bar the whole squared, and hence you will try to find, so you will take the deviations considering 24.09 and then 8.79, and the deviations come to 9.54 and 4.83. So you will need some practice over here. X minus X bar the whole squared into P. So essentially what you're doing is 9.09 minus 24.09 into equal to, so that is squared, and then into 0.2 comes to 45, so on so forth. If you do, this will come to 91.09, you square root it, and that will ultimately come to 9.54. If you have to comment on the risk only looking at the standard deviation, we will say that the company which has the highest standard deviation has a higher risk, and thereby it is M. However, another ways like coefficient of variation, which is standard deviation upon X bar, can also be used, but the question over here has asked you to compare on the comparative risk using standard deviation, and hence you will conclude that M has a higher risk as it has a higher standard deviation compared to N. Now this is question number 1. Now another question is question number 2, which is a fairly tricky question. You have the returns of portfolio A and the market portfolio, which is given for 12 months. Now this is a monthly return which is given for A as well as a market portfolio, and then the standard deviation which is given at the end, okay, for A as well as a market portfolio. You are required to find out how much of the monthly returns are attributable to the sheer skill of the portfolio manager. Skill means your ability to earn more than what is required. You might be earning higher, but that may be because you are investing in a very risky security. But if you are able to earn more than the required return, what is called as Jensen's alpha, that is due to your skill. And what part of the monthly return is attributable to the higher risk assumed by the portfolio manager? So you might be investing in a portfolio which has a beta of, let us say, 2 times. Then a part of the return that you are having higher is because you are investing in a portfolio which has a higher risk. So we want to segregate how much is the excess return attributable to the skill as well as how much is attributable, let us say, to the higher risk. Assume that the risk-free rate of return is 12% per annum and the portfolio is fully diversified. 12% per annum is approximately 1% for each month. So if I look at the average return, I will take all of these 12 monthly returns and divide it by 12. As you can see over here, your answer will be around 2.1825%, the average return for the portfolio A. Similarly, I'll try to find the average return for the market. So if I try to find the average return for the market, I will take all the returns, 0.82, 0.04, 2.8, all of them, total them up, divided by 12, that will give me the average return. So over here, as compared to the market, which is giving 1.45, I am earning 2.18. So basically, I am earning an excess return of 2.1825 minus 1.4558, and hence 2.1825 minus 1.4558, this is coming to 0.7267%. Now a part of this excess return is due to the skill, a part of it is due to the risk. Now we need to figure out how much is due to the risk and how much is due to the skill. The part attributable to skill is calculated using Jensen's alpha, but the part attributable to risk, you need the beta. Now beta could have been calculated in my limited understanding by using the formula correlation of the security with the market into standard deviation of security upon standard deviation of market. You can use the standard deviation data given over here and you can derive the correlation in my limited understanding. Now what has the institute assumed over here? Institute has assumed that since the portfolio is fully diversified, ICI has assumed that implicitly that the correlation of portfolio A to the market is actually 1. Now that is not necessary, but institute has assumed that. So considering that assumption, if I were to find the beta of the portfolio A, that is correlation of A to the market, which is assumed as 1 into the standard deviation of A upon the standard deviation of the market, which means if this is 1 into, if the portfolio is fully diversified, it only bears systematic risk. That is the assumption that they have taken, into 1.6223 upon 0.9498. So if I do this working, 1.6223 upon 0.9498, this probably comes to around 1.708. Now this is your beta. So your security will fetch a higher return because the beta is higher. So basically you can say that 1.4558, loosely speaking, as per the institute solution, into 1.708. So if I do 1.4558 into, let us say, sorry, I will have to use a CAPM equation. So if I look at the CAPM equation, I will say that risk-free rate, that is 1% plus RM. RM is 1.4558 minus risk-free rate of 1% into beta of 1.708. This should actually give you a required rate of return, KE. Even for Jensen's alpha, we will need the required rate of return. So this is 1% plus 1.4558. So this is 0.4558 into 1.708. So this is 0.7785. So we are saying that ideally you should have earned 1.7785 even if you did not have superior stock selection skills, because you are holding a portfolio which is more riskier than the market, and hence 1.7785 minus 1.4558. So this part of the excess return, 1.7785 minus 1.4558, this is around 0.3227. This part of excess return is attributable to the fact that you are bearing a higher risk. Now a student might say that the balancing figure is attributable to skill. Technically yes. However, you can find the Jensen's alpha. What is Jensen's alpha? Jensen's alpha will say that what is your actual return? We will say 2.1825, and what is your required return based on the risk? 1.7785. So 2.1825 minus 1.7785, that is around 0.404. This excess return is probably because you have picked up stocks which are giving higher return, even if the risk warrants that you should earn 1.7785%, you are actually earning 2.18, and hence the excess is attributable to your skill. So it's a fairly tricky question. One controversial assumption of correlation being equal to 1, but if you consider that and solve, it's a fairly good question for understanding and applying Jensen's alpha without specifically being asked to apply the Jensen's alpha. So over here, return attributable to stock selection is 0.404, to risk is actually 0.3227. Your skill, remember, return attributable to the skill will be nothing but Jensen alpha, and return as compared to the risk will be nothing but your, let's say, required return minus the return of the market. You are saying that you are getting 1.778 at a 1.7 portfolio beta, but market is giving only 1.45, but that is because market is a lower risk, you have a higher risk, and that is why there is a difference. Okay, so that is question number 2. 3 we will do in some time. You will go to question number 4. Now in this question you can try to find the beta, and a lot of other things can be done. Following is the information about ABC. You have been given the average price of ABC, of the market, dividend percentage and the risk-free rate. You are required to calculate the beta and the expected return using CAPM. So for beta, if you were to follow the correlation method, one of the formulas is covariance of A with the market upon variance of the market. Or if I were to solve using the regression method, then it is summation of A into M minus N into A bar into M bar upon summation of M squared minus N into M bar squared. Both the methods will give you approximately the same answer. So if we were to look at the first method, we need to find the covariance. But for covariance, we need to find the returns in the first place. We don't have the returns. So over here for ABC, we will try to find the returns. For 2000, we cannot find the return. So we will first go to the return of 2001. That is P1, 279, minus P0, that is 242, that is a capital appreciation, plus a dividend of 25. So basically 279 minus 242 plus 25 divided by, let us say, 242. In percentage, if you do, this will come to 25.62. That same working will proceed for the next year 2002 and the next year 2003. This is typically given in most of the questions. Here it is not given, so we are trying to calculate. Okay. Next you go to market. Now when you look at the market, you can still do market return as P1 minus P0, but the problem is market dividend is given in percentage. Now market does not have a face value and hence the market dividend is a percentage of the price only. So over here if I go to the market, it will be 1950 minus 1812. So this is a capital appreciation. P1 minus P0 upon 1812. So 1950 minus 1812 upon 1812. This will give you the capital appreciation of 7.62%. Now this is a percentage of price. To that you will add the dividend percentage that was obtained, which is also a percentage of price, and hence this will be 7.62 plus 5% and hence 12.61 or 62 as the case may be. This is a return for the market for the year 2001. A similar working 12.62 can also be done for 2002 and 2003. And now you at least remember for beta, you can't just directly calculate using the share prices. Your Sensex may be at 80,000. Your security might only have a 800 price. You may deviate by 80 rupees. For you, that's a 10% deviation. If Sensex deviates by 10 rupees, from 80,000, it deviates, let's say, by 80 rupees. It's hardly a 0.1 or 0.01% deviation. So to compare 80-80 and say that, okay, the portfolio, let's say beta is 1, it's wrong. You have to find the percentage return. And hence, based on that find. So whenever you are asked to find beta and you are not given prices which are in percentage, you first convert them into percentage and then talk. Okay. Yeah, there was some technical issue in the remaining part of the lecture and hence I am recording it again. So let us continue from where we left. We were discussing regarding the calculation of returns and applying that into the beta formula. We said that the beta has to be based on returns which are calculated in the form of percentage. Now, how do you apply this? Let us say using the first formula that you had, covariance upon variance of the market, where we kind of use the standard format of the table where we put in the returns of ABC, we put in the returns of the market and then try to find the covariance. As you can see over here, this is ABC. The returns have been put in, the market, the returns have been put in, and then you try to find the A bar as well as the market bar. So the average return of ABC is 20.91, the average return of the market comes to around 13.24%. That is simple average because there are no probabilities over here. However, when you go to the covariance calculation, covariance is A minus A bar, that is A minus 20.91 into M minus M bar, that is M minus 13.24, and you will come to around 20.47. Because there are no probabilities, you will divide it by, let us say, 3 to find the covariance. Your covariance, let us say, comes to around 6.82. Now the beta is covariance upon the variance of the market. So when we did this M minus M bar 0.62, 8.55, 7.92, you will square it to get your answers. And hence this is 136.21 divided by 3, that will give you the variance of the market. If you want to square root it, that is the standard deviation, but this will give you the variance of the market around 45.4, and the beta, as you can see, can be calculated as the covariance, that is 6.82 divided by the variance of the market, that is 45.4, and hence your beta comes to, let us say, 0.15. Now this is calculation using the standard method. Again, you can take the beta of 0.15 and apply that in CAPM. The problem over here is in CAPM, you need the RF. Now there are four different RF numbers. There is 6%, there is 5%, 4%, 5%, various RF numbers, but one needs to be remembering that your RF has to be consistent with the other data, like your market return was calculated for the year 2001, 2002 and 2003, and if the market return is for 2001, 2 and 3, then your ABC return is also for 1, 2 and 3, and then your RF should ideally be for 1, 2 and 3 only, and hence if I were to take the simple average, this is 5 plus 4 plus 5 divided by 3 will come to approximately 4.67%. That will be your RF because it is based on a consistent base. So this is 4.67 plus RM, which is calculated as 13.24 minus RF of 4.67 into beta of 0.15, and that will give you, let us say, once you get this 4.67%, that will give you 5.96%. That is your return using CAPM. Now this is a standard working. If you want, you should pause and try this all over again, because this is a question where you are applying all of these covariance, variance, standard deviation, all of these formulas, CAPM, everything. However, an alternative method which is there in the study material for this particular question, you can see the test your knowledge section, and also a question that came in your exam where institute used only at these two places an alternative method. We have even put a separate video on YouTube which is alternative method of beta, and that alternative method, as we discussed earlier, would be calculated as your beta would be summation of A into M. Now how do you calculate A into M? For example, 25.62 into 12.62. That, as you can see, will come to, let us say, 323. Then 20.27 into 21.79, that is 437, and 17.05 into 5.32, this is 90.71. So here there is no question of x minus x bar or anything. You will directly take whatever is the return of A into the return of the market and find A into M summation. That comes to 851.35. Secondly, in the denominator, so you have this working in the denominator, you need summation of M squared. Now that is very easy. 12.62 squared, that is 159. 21.79 squared, that is 474, and around 5.32 squared, that is 28. Total comes to 662. If I divide this 662 in the denominator, and then you already have N, that is 3 observations, A bar which is around 20.91, M bar which is around 13.24. If you substitute those numbers over here, you should be landing up to approximately, or rather in this case exactly the same beta. So question always arises that, sir, will we have to solve using a particular method? In my opinion, no. You can solve in either of these methods, whatever you feel is more comfortable and whatever you think you can solve faster. You can solve that and apply that consistently, though most of the solutions of the institute are done based on beta is equal to covariance upon variance of market, except for these two places, that is one in your test your knowledge for a similar question like this, and again one in the exam question again for a similar question like this, where they have used this single beta formula. So from an exam perspective, if I have to think, I would say either of them would work. But if you are of that school of thought that I want to follow the institute's pattern only, then generally if a question like this comes where you have a return of ABC, whether you have dividend, market, data like this comes, even if the numbers are slightly different with different RFs, you might as well follow this method, because institute at two places has done this method. Though in every other problem you can follow covariance by variance of market if you just want to be consistent with the institute. Having said that, in my opinion, you solve using either of these methods, your answers are coming the same, and hence it should not ideally matter. Perfect. So that takes care of question number 4. Next you go to question number 5. Here we study about the concept of characteristic line. We apply the characteristic line concept. So reviewing this, the returns of stock A and the market portfolio for 6 years as given. So you have return of A for 6 years, market again for 6 years, you have some positives and negatives but no probability is given. You are required to find the characteristic line for stock A. Now how do you find the characteristic line? Well, characteristic line is X is equal to, or rather in this case A is equal to alpha plus, let us say, beta M. Now you will have to calculate beta. Further you will have to calculate alpha. Alpha is nothing but A bar or X bar minus beta M bar. So calculating A bar and M bar should not be a challenge. So if I take the total over here, this will be, I think, 38, this will be around 34.5. You divide it by 6 observations at either of these places and you should land up with 6.33 and 5.75. This should be quite basic. This is your A bar as well as M bar. However, For characteristic line you need beta, and how do you calculate beta? As we just said, this is covariance of A with M upon variance of the market. So you make your standard 6 column or 7 column table where you put in A, where you put in the market, then A minus A bar, as you can see over here, M minus M bar over here, and that comes to 289.5 divided by 6. That will give you covariance of 48.25. Variance of the market over here, honestly I don't really need, at least for 0.1, the standard deviation of A. Later if needed we will see. And second is M minus M bar the whole squared, which again you should pause and try to do this math, because I mean I can discuss this into this, but unless you do it and you apply it, you will not get that confidence. So if possible, just pause and try over here to do the math. If you are comfortable, you can proceed. So this is 240.86 again divided by 6, and that will give you around 82.89 at variance level. If you square root it, 9.1 will be the standard deviation of the market. Now once you have this data, you will say 48.25, which is a covariance, upon let us say 82.89, and hence this will come to approximately 0.51, which is your beta. And once you have the beta, we can also for characteristic line find the alpha. Alpha is equal to A bar, which is 6.33 minus 0.51 into M bar. So this is 5.75, and hence this will probably be equal to, I think, 0.51 into 5.75, and 6.33 comes to what? 3. No, this is beta is okay. Sorry, this is 48.25. Oh, this is wrong. This is A ka working. I took a wrong working over here. This is M's working. 40.14. My bad. Sorry. So this is 40.14, 48.25 upon 40.14. I have to take the variance of the market. Over here we have also done the working for A, so this is around 1.2, and if I do the working at 1.2, 6.3 minus 1.2 into 5.75, 5.75 into 1.2 and 6.33 comes to, I think, negative 0.57. And hence if I have to build a characteristic line, that is A is equal to alpha, that is negative 0.57 plus beta, that is 1.2 M, that is your characteristic line. So from an exam perspective, this should be your equation for a characteristic line. Now the second part says systematic is equal to unsystematic risk of stock A. Now systematic risk, remember, is your beta squared of the stock into variance of the market, which you have done, or it is correlation of the stock with the market squared, which you have not yet found, into the standard deviation squared of the security. So in this case you can calculate the systematic risk as beta squared, that is 1.2 squared, into the variance of the market, which we just found as 40.14, or you can say this as 6.34 squared, in which case 1.2 into equal to, that is 1.44 into 40.14, approximately this is 57.80. Now this is where you will face a challenge. If you have to calculate unsystematic risk and you have just prepared columns where standard deviation of A was not there, one needs to be remembering that the unsystematic risk is a total risk, that is total risk of A less the systematic risk, everything done in squared terms. So when I do the workings for unsystematic risk, I will say that I will need to find for A, that is A ke liye I think it was 9.1 squared, that is a total risk 82.89 minus 57.8. So this is approximately 82.89 minus 57.8, and that is approximately 25.09. The question asks you unsystematic risk, you will leave it at 25.09. However, if they ask you to calculate what is called as random error, for random error you will square root the unsystematic risk. 25.09 square rooted will give you the random error. In this case, if you see around 25 and this is around 57, will give you the systematic and unsystematic risk. So that is regarding question number 5. Now question 6 is an interesting question. It is a good question for practice because a lot of concepts or a lot of different formulae are also applied over here. Let us try. A study by a mutual fund has revealed the following data in respect of 3 securities. You have standard deviation and you have the correlation with the index. It is very important to know that this is correlation with the index. That is correlation of AM. This is like R. AM. R is a correlation. R of BM. R of CM. Okay. The standard deviation of the market portfolio is observed to be 15%. This is standard deviation. What is the sensitivity of the returns of each stock with respect to that of the market? Remember, sensitivity over here is similar to that of beta. For beta, you need to calculate, let us say if I were to do for stock A, that is correlation of A with the market, which you have, into the standard deviation of A, which you have, upon the standard deviation of the market, which also you have, which is basically 0.6 into 20 upon 15, which will come to probably 0.8. Then similarly, you do a working for B, which is 0.95 into 18 upon, let us say, 15. So 18 into 0.95 upon 15 comes to 1.14, and for C, if you do, the working is 0.75 into 12 upon 15, so probably this comes to 0.6. So the beta is quite easy, 0.8, 1.14 and 0.6. The important part in my opinion is the second one, where they are asking you to find the covariances amongst various stocks. Now in order to calculate covariance, we need a range of data, x minus x bar into covariances amongst various stocks. So they are asking you covariance of xy, not covariance of x and market. Covariance of xz, not covariance of x and the market. Covariance of b, let's say y and z. Here it's ABC, I think, but the covariances are asked among the various stocks. So what a student typically makes a mistake, they see that okay, x minus x bar etc. data is not possible over here, but they say no, we have studied one more formula. The formula typically goes like this, that correlation equals covariance upon standard deviation x into standard deviation y, but this will give you correlation of xy. The problem is in this question we don't have correlation of xy, it is correlation of x with the index, and hence I can always say that we will rearrange to find, but to rearrange, yes, you have standard deviation A, you have standard deviation B, but you don't have correlation AB, you have correlation of A with the market, and hence this formula where you rearrange and find does not work. So which is the formula that you will apply? Well, the formula over here is, if I want to take the covariance of AB, another formula is I will take beta of A into beta of B, which I have, into the variance of the market, which also I have. Like I can take 0.8 into 1.14 into 15 squared. This will come to around 205.2 or something, as you can see over here, 205.2. Similarly, for the second, for covariance of A and C, I will say 0.8 into 0.6 into 15 squared. This will come to probably 108. And last में covariance of BC, which is 1.14 into 0.6 into 15 squared. So if you were to calculate, just a second, 0.6 into 1.14 into 225, that is 15 squared, is 153.9. As you can see, these three numbers flash in front of you. This is an important working to know when to use the correlation xy is equal to covariance upon standard deviation x, standard deviation y, and when to use this beta formula. In this particular case, you are able to use it because the question requires you to find the covariance of xy and not x and the market. If they had asked you x and the market, we can directly use this 0.6 and find the answer. What is the risk of the portfolio consisting of all the three stocks equally? Well, that is a portfolio standard deviation of, that is a simple formula for three securities, A plus B plus C the whole squared, that's A squared plus B squared plus 2AB plus A squared plus B squared plus C squared plus 2AB plus 2AC plus 2BC. So over here, I will say if the weights are equal, if I do the working under the root, weight squared, that is 1 by 3 squared into the standard deviation, I think 20 squared, 1 by 3 squared into the standard deviation, I think 18 squared, and 1 by 3 squared into the standard deviation, let us say this is 12 squared. So this is your first working, plus 2 into weight of A into weight of B into the covariance of AB, which is 205.2. Now typically we take standard deviation A, standard deviation B into correlation AB. I don't have correlation AB, but I have covariance AB. So I can directly take, instead of standard deviation A into standard deviation B into correlation AB, I can directly take covariance, plus 2 into again 1 by 3 into 1 by 3 into, let us say, covariance AC, which is 108, plus 2 into 1 by 3 into 1 by 3 into covariance of BC, which is 153.9. So if I do the working, 1 by 3 squared remains the same everywhere, and hence I can take that common. So basically if I do 1 by 9 outside, 20 squared will probably be 400, 18 squared 324, 12 squared 144, plus 2 into 205, that is probably 110.4. 2 into 108, this is 410. This is 216 and 307.8 approximately. If you do this working, you should be getting around 200.4 square root this to find the standard deviation, and hence it comes to 14.15% for the portfolio. Okay, so this is a question where you can also practice the working for a 3 security portfolio standard deviation. And then what is the beta of the portfolio? Well, beta over here is a weighted average, that is 1 by 3 into the beta first of 0.8, 1 by 3 into the beta of 1.14, and 1 by 3 into the beta of 0.6. So if I do this working, I should be getting 0.85. This is my portfolio beta, weighted average. And last, what is the total systematic and unsystematic risk? Sir, we found it earlier. Earlier was for a single security, now this is the portfolio. So if it is for the portfolio, your working remains the same. You will say that your total risk, for example, over here of the portfolio ABC in squared terms will be 14.15 squared, that is around 200.24. Systematic risk of the portfolio is beta of ABC, not just beta of A, not just beta of B, not just beta of C, into the variance of the market, which is 0.85 squared into 15 squared. 0.85 into equal to into 225 comes to 162.56. So let us say this was 162.56. So if I subtract in squared terms, I do get the unsystematic risk, which is approximately 37 point something. So this is 37.66 or 67 as the case may be. This is your unsystematic risk. If the question had asked you to find the random error, you would have taken the square root of that to find the random error. Okay, so this kind of takes care of a question where you are asked to calculate the portfolio standard deviation, portfolio beta, covariances among stocks, systematic, unsystematic risk. Lot of points to be revised over here. In fact, the institute could have made it a little more complicated, where they could have said calculate the portfolio risk of these 3 stocks using the Markowitz formula. Markowitz formula. If they had told you Markowitz formula, this is the same formula as per Markowitz. But what if they told you to calculate using Sharpe's index model? Well, the formula using Sharpe's index model over here would be, you will have to calculate the beta ABC squared, which you have, into the variance of the market plus weight squared A into the unsystematic risk of A plus weight squared B into the unsystematic risk of B plus weight squared C into the unsystematic risk of C. Now you will have to find the unsystematic risk for each of these stocks separately and systematic risks as well. So this might be a little more tedious, but one needs to know. Institute rarely asks you that, but it has once asked you to calculate portfolio risk using the Markowitz formula, which is the traditional formula, or using the Sharpe's index model, in which case that is the systematic risk of the portfolio plus the unsystematic risk of the individual securities in the portfolio. In case that is asked, we are quickly just reviewing that this should be the formula that you should be applying. Your final answer should ideally be the same, unless there's a printing mistake in the question, which was there in one of the institute's problems. Okay, next you have questions regarding arbitrage pricing theory, APT, question 7 as well as 8 pertaining to APT. Let us review this. Question number 7, Mr. X owns a portfolio of the following characteristics: factor 1 sensitivity, factor 2 sensitivity. We don't know what factor 1 is. Maybe it is inflation, maybe factor 2 is oil price, exchange rate, it can be anything. And then there is an expected return of 15%, 20%, and risk-free security obviously has zero sensitivity, zero beta to any factor. And then there is a 10% return. Okay, an important point which is mentioned over here, it is assumed that the returns are generated by a 2-factor model. Remember, CAPM is a single factor model, that is, it has only market as a factor. However, when you look at the 2-factor model, that is APT. So over here returns are generated by APT. If Mr. X has 1 lakh to invest, okay, and sells short 50,000 of security B. Acha, when you sell short, that means you don't invest money. In fact, you get money. Your amount invested is a weight, but here instead of investing money, you are getting it. So your weights become negative. And purchases 1,50,000 of security A. What is the sensitivity of Mr. X's portfolio to the 2 factors? So for subpoint A, you will first have to find the weights of A and B. In A, you have invested entire 1 lakh. in B negative 50. In fact, whatever money you got, you invested in A. So this is 150 and this is negative 50, which means on a total 100, this is 1.5. This is a negative 0.5 and hence your subtotal, let us say, comes to 1. Okay. So now you want to find the sensitivity of excess portfolio to the two factors. Now excess portfolio comprises of A and B. In factor 1, I will say A's weight is 1.5 into 0.8 plus, if I look at security B has a negative 0.5. So this is 0.5. So it is like weighted average. Basically weight of A, that is 1.5 into beta of A to factor 1 plus a weight of E, which is minus 0.5 into beta, that is 1.5. If I do this working, probably this is 0.45. Similarly, this is for factor 1. Acha, as many factors, utne hi sensitivities. For factor 2, again 1.5 into 0.6 plus a negative 0.5 into, let us say, 1.2. If you do this working, you will probably get around 0.3. So the question wants you to find the sensitivity, that is portfolio beta. Sir, wo to last question also was asking, but last question had a single factor. This has multiple factors. So for two factors, there will be two portfolio betas. Sir, are there two portfolio betas because there are only two securities A, B, C? No. Even if there were 5 securities A, B, C, D, E, and there were only two factors, you will have two portfolio betas. Jitne factors, utne portfolio betas. Are we clear with this? So this will be like weight of A into beta of A plus weight of B into beta of B plus weight of C into beta of C to each of these factors, and you will get your answer. Okay, point B is a little tricky. If Mr. X borrows 1 lakh at risk-free rate, let us stop over here. This is a point where you will possibly make a mistake. Usually, let us say it was told that Mr. X invests 1 lakh rupees in a risk-free security. Would you have taken it in your portfolio? The answer is yes. Why? Because amount invested, by the way, even if it is in a risk-free security, that is your amount invested, and hence you should take it. In a similar way, had you been told that you have short sold a risk-free security, would you have taken it in your weights? Well, of course, because when you are short selling something that has a negative weight, you get money. Here, what is borrowing? Borrowing is, remember, similar to short selling. Like when I need money, what do? I issue bonds, I sell bonds, and I raise my money. When I have surplus funds, what do? I invest, deploy money in my bonds or in bonds. So borrowing is synonymous to short selling of the bond, and hence you should not ignore the borrowing. Otherwise you will say, "Okay, yaar, you have borrowed money. How does it impact the portfolio?" It definitely impacts the portfolio. Had you invested money in a risk-free bond, that would have impacted the portfolio. Had you got short sold the risk-free bond, that would impact the portfolio. Similar is the case for borrowing. Borrowing, for all practical purposes, in a portfolio setup is similar to selling the bonds, selling securities. And invest the amount he borrows along with the original 1 lakh in A and B in the same proportion as described in part 1. What is again the sensitivity of the portfolio to the two factors? So now if I go to see, my portfolio comprises of what? Sir, my portfolio comprises of 3 items now. It comprises of security A, security B, and also a security F, like the risk-free security. So when I look at the amount invested originally, this is 100, this is 50, and 50 further that I short sold was invested. What do? Well, I borrow, that is at risk-free security, it is a negative 100. What do? I deploy everything in A as it is given in the question, but the question says in the same proportion. Now if I deploy just 100 and leave it over there, that is not in the same proportion as in part 1. So I'll say, okay, that means I'll have to further short sell 50, and whatever proceeds I will get, I will invest it over here, and as a result, my total investment is minus 300, plus 300, minus 100, minus 100, and hence my total investment is 100 only, and the weights are 3:1, -1 negative. So if I were to find a portfolio beta over here, to factor 1, I will say 3 into, let us say, 0.8 for security A, plus a -1 into 1.5, plus a -1, let us say, into 0, but for academic completion take that, factor 2, 3 into 0.6 plus -1 into 1.2 plus a -1 into 0. If you do this working, probably this is 0.9 and probably this is 0.60. This is your portfolio betas if it is required. And the last part says what is the expected return premium of factor 2? This is like lambda of factor 2. Now, how will I find lambda? Well, we have been given that the returns are generated by a two-factor model, factor 1 as well as factor 2, and hence if I were to use the APT formula will tell me that the return of security 1, that is 15%, will be RF, that is I think 10%, plus lambda of factor 1 into beta of factor 1. This is only and only for A, so that will be into 0.8, plus lambda of factor 2 into beta of factor 2 for A, that is 0.6. If I rephrase this, 10 I will take on the other side, so this will become 5. Similarly, if I look at the second security, 20 is equal to 10 into lambda of factor 1 to B, which is I think 1.5, plus lambda of factor 2 to B, which is let's say 1.2. Again, if I take 10 on the other side, ultimately this will become, let us say if I were to do the working, ultimately this will become 5, that is 15 minus 10, and this is 10. Now, if I were to look at this, these are two equations, I will multiply one of them. Let us say I'll multiply the first equation by 2 times on both RHS and LHS, in which case my answer would be 5 into 2, that is equal to 10, 0.8 into 2, that is lambda factor 1, 1.6, plus 0.6 lambda factor 2, 1.2. So basically if I subtract this, lambda factor 2 will get cancelled, and hence you will have negative 0.1, lambda factor 1 equals to 0. So basically lambda factor 1, if you solve, will be 0. However, as you can see, this is coming to 0. However, if I were to substitute this 0 in any of these equations, for example, 10 is equal to 1.5 into 0 plus 1.2 into lambda factor 2. If I do this working, this is 10 equals 1.2 lambda factor 2. Therefore, lambda of factor 2 or risk premium or return premium of factor 2 will come to 8.33%. Okay, so this kind of takes care of question number 7. The important part over here is to apply APT, and most importantly figuring out that when you are borrowing, it is similar to short selling of a bond. Now question number 8 is also an arbitrage pricing theory or multi-factor model, but there are 4 baskets. Mr. Nirmal Kumar has categorized all the available stock into the following types: small cap growth, that is A, small cap value B, large cap growth C, and large cap value, let us say, D. Mr. Nirmal Kumar is also estimated the weights of the above categories of stocks in the market index. So these are weights given in the market index. If I want to find the market return or market value, these are weights given. Furthermore, the sensitivity of returns of these categories to the 3 important factors. Usually in CAPM there is only one factor. Here there are 3 important factors which are given. Factor 1, which is called as a beta, is against the market. Like you might be a brokerage firm like Motilal Oswal or Edelweiss. For you, the market is also an important factor. Factor 2 is the book price, and factor 3 is the inflation. You have been given for each of these values, and at the end, important is you have been given the risk premium. Like in the last problem, you had to find the risk premium. Here, if you have to see, the risk premium is given at 6.85, negative 3.5 or 0.65, this is given. You are required, you are told that the rate of return on the treasury bonds is 4.5%. This is like your RF. Required to use the arbitrage pricing theory and APT, determine the expected return on the market index using APT, then using CAPM. Now, if I look at APT, I will say my market portfolio comprises of these 4 items. Now, in these 4 items, I can say that if I have the weights, then these 4 items are 4 stocks are there, and there are 3 factors: factor 1, factor 2, and factor 3. So ideally, if I look at the return of the portfolio 1, 2, 3, 4, I will say this will be RF plus lambda of factor 1, which is 6.85 given to us, into beta of factor 1 for 1, 2, 3, 4, plus a negative 3.5 again, which is given to us, into beta of factor 2 for 1, 2, 3, 4, and last में 0.65 into beta of factor 3 to 1, 2, 3, 4. Now, if I am able to solve it for one of them, the same process will apply everywhere. So this is like 0.8 weighted average beta. How do you calculate? 0.8 into 0.25 plus 0.9 into 0.1 plus 1.65 into 0.5 and 0.85 into 0.15. So if I do this working for portfolio beta, this would come to, let us say, 1. The same math with the same weights you will take for second factor and the third factor. So once you have these three numbers and you substitute them, 4.5 plus 6.85 into 1 plus a negative 3.5 into 2.105 plus 0.65 into 5.8, and you get 7.75%. So basically your required return using APT is using one of these methods, that is, you can find 3 portfolio betas and then use that in the KE for the portfolio. Alternatively, you can find the required rate of return for small cap growth separately, small cap value separately, large cap growth separately, large cap value separately, 4 different KEs for stocks A, B, C, D. After that, we say that the weights over here are 25, 10 and 50 and 15. You multiply that and you get exactly the same answer of 7.75% to the last decimal. Okay. Next, you have using CAPM, determine the expected return on the market index. Now, using CAPM does not look at book price, CAPM does not look at inflation, but CAPM very well looks at the market. Okay. And if I look at the market, beta sensitivity is coming as 1, and the risk premium, what is risk premium? Like the lambda, this is like the return of factor 1, like the market minus the risk free rate. So if I were to use CAPM, I would simply say 4.5 plus 6.85, which is the risk premium, into 1, and you will be getting 6.85 plus 4.5, which is 11.35%, as you can see over here. Okay. And the last one, Mr. Nirmal Kumar wants to construct a portfolio consisting of only small cap value, that is B, second category, and large cap growth, that is C. If the target beta for the desired portfolio is 1, determine the composition. Beta is against the market, at least at what is given in the question, beta is against the market. So if your target beta is 1 into the weight of B, I don't know what that is, into the beta of B, that is 0.9, plus the weight of C is nothing but 1 minus the weight of B, into 1.165. Once you formulate this equation, you will solve for weight of B and weight of C, and you will get your answer at 62 and 37.75% respectively. So that is regarding question number 8. If you look at question number 9, this is on geared and ungeared beta concept. The equity beta of ABC, the equity of ABC is 500 crores and its debt is worth 290. That means a total of 790 crores. Printer division segments value is 64% with an asset beta. This is the first time we have directly been given an asset beta of 1.55, and balance value is attributable to stores and consumables division, which has again an asset beta of 1.4. Acha, balance value to stores and consumables. If my business has 2 divisions, one is 64%, the remaining should be 36%. ABC's debt beta is 0.28. What are you required to do? Well, first find the equity beta. Now the thing over here is, this time around you want to find the asset beta of the company. Asset beta will be based, usually you take a comparable company, proxy company, and using its equity beta you come to the asset beta, but you have already been given asset beta, but that is division wise. So one of the division has a beta of 1.55 asset beta, into its weight is 0.64, the other division has an asset beta of 1.4, its weight is 0.36. So if I were to do 1.55 into 1.55 into 0.64 m plus, 1.4 into 0.36 m plus, and you will get 1.496. Now this is your asset beta. But however, I want to find the equity beta. So we will say that if the asset beta is this, equity beta, how do you, okay, what is asset beta? Asset beta is the beta of debt into the weight of debt. Achha, what is the beta of debt? Well, beta of debt is given to me as 0.28 into the weight of debt, that is 290 upon 790, plus equity beta into the weight of equity 500 divided by 790. And if I solve this, I am going to get the asset beta, but I already have the asset beta, that is 1.496. So if I were to solve this, 1.496 equals 0.28 into 290 upon 790 comes to, I think, 0.103 equals beta plus beta equity into 500 plus 790. And if you do this working, you will ultimately come to equity beta of 2.2. It's just solving of an equation. Okay, what is 0.2 saying? Ascertain the equity beta if ABC decides to change its debt to equity position by raising further debt and buying back equity to have its debt to equity ratio at 1.5. Now, if the revised debt to equity ratio has to come to 1.5, my existing debt is 290 plus I will issue new debt, let us say X. My existing equity is 500. I use the money that I raised from debt to buy back equity. So this is, let us say, minus X. And hence this will equal to 1.5. So if I were to solve this, 290 plus X equals 500, that is 750 minus 1.5X. If I take 750 on the other side, minus 290 comes to, let's say, 460. And over here, 1.5, so this is equal to 2.5X. Divided by 2.5 comes to 184. So I am going to raise 184 worth of new debt. Assume that the present debt beta is 0.45 and further funds will have a beta of 0.5. So what will be the equity beta? It will still be weighted average. My existing beta is 0.45 into 290 again upon 790. New debt is 0.5 into 184 upon 790. And now the equity beta I don't know into weight of equity, which is 790. Acha, earlier my equity was 500 minus 184 will be used. 500 minus 184 and you will be left with 316. All of this will equal 1.496. So you have an equation where there is only one missing variable, that is equity beta. You solve this and you are going to get your answer. Last, they say whether the new equity beta justifies increase in value on account of leverage. It depends. If this new equity beta results in a higher market price, then it justifies. If it does not result, then it does not justify the increase. So over here, you can solve. The new equity beta is around 3.036. Once you formulate the equation, you can just solve it and you can get the answer. Now another sum over here is a specific question pertaining to short selling. Now short selling comes under usually the advance borrowing and lending mechanism or stock lending mechanism. Under stock lending mechanism, what happens? If I am the true owner of the share, I don't want to sell the share for a long term. I will lend that share to someone. I'm not selling my share, I'm just lending it, which means I am still the true owner. It is like saying that when I want to take a loan, I go to a bank, take a loan, I give my gold. I give my gold as a security, I don't sell my gold. In a similar way over here, I'm just lending my shares, which means as per the stock lending mechanism, on that lending, usually you lend money, you get interest, you lend shares, still you should get some income or interest, that is right. That will be income for you, who is the true owner of the share, and for the person who is short selling that share, that will be a cost. But at the same time, the question always arises that who will get the dividend? The dividend is ultimately received by the true owner of the share. How that happens? That is beyond the scope currently. However, if you even Google up or see SEBI rules, or even let us say this question by the institute, they have correctly said that the true owner will ultimately get the dividend. How it actually happens operationally is not something that we have to look for, but from a fundamental level, remember that dividend is going to be received ultimately by the actual true owner. Sometimes exchanges might require the person who is borrowing the shares also to give a bank guarantee. Now for the bank guarantee, that is peace of mind for the true owner or for the exchange, but bank guarantee comes with a cost. That is a cost that the short seller who is borrowing the share has to pay. Having said that, that is not an income for the true owner. If there is any commission charge, that is an income for the bank. So the question might ask you to find the income from stock lending, in which case that is purely that interest charges that you will receive on lending of the shares. Okay, let us review that and apply those numbers over here. So Mr. A is holding 1000 shares with a face value of 100 each. Messrs in ABC, he wants to hold these shares for the long term and has no intention to sell them. On 1st January, XYZ has made short sales of ABC shares and approached Mr. A to lend his shares under the stock lending scheme. So who is the true owner? Mr. A. Who is the short seller? XYZ. Shares are to be borrowed for 3 months from 1st January to 31st March. Lending charges or fees of 1% to be paid for every month on the closing price of the stock quoted on the exchange. This is on the closing price. Bank guarantee will be provided as collateral on the value on 1st January 10. Cost of bank guarantee is 8% per annum. Mr. ABC shares is quoted on various dates. So you have the share price under the bullish and the bearish scenario. On 29 February, ABC declares a dividend of 25%. This is usually a dividend on face value. If I were to quantify the dividend amount, these are 1000 shares of the face value rupees 100 each, first line, into 25%. So this will probably be 25,000. This will be income for Mr. A. This will ultimately go to Mr. A. You are required to find the earning of Mr. A through stock lending scheme. Now, through the stock lending scheme, they are going to earn interest. Remember this 25,000 of dividend they would have earned even if they had not done the stock lending. So for the month of January, 1020 per share into you have given 1000 such shares into I think 1%, that will come to 1020 into 1000 into 1% comes to 10,200. Similarly, for the second, this is 10,400, this is 10,500, and if I do the working, this is 31,100 of total income that you will earn. This is purely and purely due to stock lending. Second, total earnings of Mr. A during this period under both scenarios. So in the first scenario, 31,100, so you will earn. Other than that, 25,000 you will also earn because you are going to get the dividend, total earnings including dividend. So this is 56,100. So as you can see over here, 31,100, 56,100. And then part C says, what is the profit or loss to XYZ on shorting the shares through stock lending scheme? So in the bullish scenario, I have sold at 1,000. But I will have to buy it when the price becomes 1050. The price is actually increasing, and hence there is a loss of 50 for each share, and there are 1000 such shares. There's a 50,000 loss. Over and above that, I also have to pay 31,100 as a part of the stock lending cost. And other than that, I have given a bank guarantee which is for 1000 shares at the rate of 1000 because that is the 1st January rate, into 8% per annum into 3 by 12. So this is what? 10 lakhs into 8% into 3 by 12 comes to 20,000. So that will be your overall cost burden, which will come to probably 1,01,100. Okay, so this kind of takes care of question 10 and all the sums on portfolio. I hope this session has been helpful for you. Till then, I'll see you in the next session. Till then, good luck, goodbye, and study well. Have a good time and all the best for your preparations.